Well, a lot of everyday investors were sitting safely in standard funds, earning, a very respectable 15% a year. Someone else was quietly compounding their money at an unbelievable 34% annually over the exact same 10-year stretch. And no, we are not talking about some lucky crypto bet or day trading individual stocks. We're talking about a publicly traded, fully regulated ETF. So the real question we need to ask isn't whether standard index funds are good. It's whether you're leaving serious money on the table without even realizing it. To really put these stakes into perspective, let's look at the hard numbers. Say you invest $500 a month for 10 years at a 7% average return. That's pretty typical for a retail investor after fees and emotional selling. You'd end up with roughly $86,000. Not bad. But run that exact same $500 a month at a 23% return, you're suddenly looking at over $220,000. That is the exact same discipline, the exact same amount of cash out of your pocket, but a completely wild difference in the outcome. And it's purely dictated by the structural ETF you chose to buy. That massive gap, that's exactly what we're unpacking today. Now, quick reality check. Past performance absolutely does not guarantee future results. We all know that. But we can and really must analyze these funds to uncover their structural advantages. We're looking for historical patterns, right? We want to see which funds held up when the market crashed, which ones bounced back the fastest, and which ones have hard-coded advantages baked right into their design that let them compound wealth like crazy. We aren't hunting for one-hit wonders here. We want consistent, battle-tested systems. So let's start with the foundational vaults where most folks safely park their capital. This quote perfectly illustrates why the Vanguard Total Stock Market ETF, or VTI, is an absolute staple. It doesn't try to pick winners, it just owns the whole shebang. For a ridiculously low fee of 0.03%, VTI holds all 3,500 publicly traded companies in America. We're talking every size, every sector, literally every corner of the U.S. economy. It's the exact kind of highly efficient, no-nonsense instrument Warren Buffett is always talking about. Now, when we stack VTI up against VOO, which is the fan-favorite S&P 500 benchmark, we see a really fascinating structural difference. VOO tracks the 500 largest U.S. companies and relies on this awesome self-cleaning mechanism where dying companies get booted and new rising stars are added. That specific feature helped VOO slightly edge out the broader market over the last decade with a 14.95% return. But on the flip side, VTI gives you exposure to the mid-sized and smaller companies that haven't quite cracked the S&P 500 yet. Essentially, you're getting early access to the mega caps of tomorrow. But what's truly mind-blowing is how the Vanguard Total World Stock ETF, or VT, takes this diversification idea to the absolute extreme. If you just want one single fund for your entire portfolio, VT is an incredibly elegant solution. It automatically balances your exposure by holding over 10,000 stocks across 49 different countries. You literally never have to stress about how much US versus international you should hold. The market just decides that roughly 60-40 split for you completely automatically. And hey, if you just want to buy a little insurance just in case American exceptionalism stalls out, you've got VXUS. This fund captures roughly 40% of global economic output by holding over 8,700 dominant players strictly outside the US. We are talking absolute global giants like Taiwan Semiconductor, ASML, and Tencent. And for a practically invisible 0.05% fee, it's basically structural insurance in case the US market goes sideways for a decade. All right, here is where things start getting really fun. The Schwab US Dividend Equity ETF, SCHD, is fundamentally different from what we've looked at because it actually pays you cold, hard cash while you hold it. It targets 100 U.S. companies with long track records of paying and consistently growing their dividends. Think mature cash-printing machines like Chevron and Verizon. Sure, they aren't those flashy, hype-driven growth stocks. They're kind of boring, to be honest. But there is absolutely nothing boring about what they do to your bank account, handing investors a 12.31% average annual total return over the last decade. And the real magic of SCHD, that reveals itself when the market crashes. During that brutal 2022 bear market where tech was literally decimated, SCHD fell only about 3%. Think about that. It proves that highly profitable, dividend-paying companies have actual, tangible cash flows that act like a heavy-duty shock absorber for your portfolio when things get ugly. Now, on the total opposite end of that dividend safety, we have the Invesco S&P 500 Momentum ETF, or SPMO. This fund uses a brilliant self-upgrading sequence to basically hack human behavioral trends. First, it systematically measures price performance over the past 12 months. Then, it adjusts for volatility to find the smoothest growth possible. Finally, it ruthlessly rotates the portfolio twice a year to drop the dead weight and load up on new leaders. By fully systemizing momentum like this, it delivered a stellar 18.51% annual return. We've officially reached the heavy hitters. These are the funds that have completely redefined what market returns look like over the past 10 years. QQQ and its lower fee sibling built for long-term holders, QQQM, track the NASDAQ 100. This gives you deep, heavy concentration in tech and growth. That massive 20.29% average annual return, that's driven by the reality that technology isn't just a tiny slice of the pie anymore. Everything from healthcare to finance to manufacturing is basically becoming a software problem. The NASDAQ 100 tracks the massive companies that literally serve as the infrastructure layer of the entire modern economy. But check this out. If you look closely at QQQ, it actually holds companies like Amazon and Meta, and strictly speaking, those are classified as consumer and communication services. So if you want to strip all of that away, you look at VGT. VGT gives you pure, 100% undiluted information technology. By filtering out absolutely everything that isn't directly software, hardware, or semiconductors, VGT generated a crazy 23.34% annual return. It is easily one of the most concentrated, high-performing sector ETFs on the planet. Which brings us to the absolute top of the mountain, the VanEck Semiconductor ETF, ticker symbol SMH. This fund delivered a truly staggering 34.09% average annual return over a full decade. I mean, just to put that into perspective for a second, a $10,000 investment in this fund 10 years ago, assuming you reinvested the dividends, would be worth over $188,000 today. Absolutely wild. The real secret behind SMH's astronomical success? Extreme concentration. It goes one level deeper than pure tech by owning just the 25 largest chip manufacturers. That's it. These companies, we're talking NVIDIA, Taiwan Semiconductor, Broadcom, ASML, they physically build the foundation that every piece of modern technology runs on. They aren't just solid companies. They represent the ultimate infrastructural choke points for literally all global technological advancement. AI, cloud computing, EVs, you name it. It runs through them. Listen, in the financial markets, absolutely nothing is free. Explosive growth, it requires surviving some absolutely gut-wrenching drawdowns. And this perfectly highlights the core focus of this entire explainer. You have to weigh the slow, highly diversified, sleep-at-night safety of a core foundation like VTI against the hyper-concentrated, high-octane rocket ship of a fund like SMH. SMH gives you massive returns, sure, but you are balancing on the razor's edge of just 25 companies. Just look at the brutal 2022 bear market. The price of admission for those high returns becomes glaringly obvious. When the tech and semiconductor cycles turned negative that year, funds like QQQ and SMH casually lost a third of their value in a single year. Meanwhile, our trusty dividend funds like SCHD held the line at just -3%. This is the massive, undeniable trade-off between volatility and long-term returns. If you want to chase that high-growth payload, you have got to mentally prepare for the roller coaster. At the end of the day, the goal of this explainer is to help you wield these wildly different tools to construct a portfolio that actually fits your specific timeline and, more importantly, your risk tolerance. Whether you want to lean heavily on the self-cleaning mechanism of the S&P 500, fortify your foundation with the reliable, boring cash flow of dividend funds, or carve out a tactical 10% allocation for the massive tailwinds of semiconductors, your success depends entirely on understanding the structural design you're buying into. Because remember, consistent systems beat one-hit wonders every single time. So, I'm going to leave you with this final thought to chew on as you build your own wealth strategy. Looking at the structural mechanics we've totally unpacked today, are you going to lock your money away in those quiet, highly diversified, foundational vaults? Or do you actually have the stomach to brave the brutal volatility for a piece of that high-growth heist? The data is all right there. But the choice of which system to trust, that's entirely up to you.